In the past few years, U.S. homebuyers haven't had it easy, but now they've got a new problem: Greenland. Now, it might sound ridiculous, but it's real, and it hit the housing market fast. An extended stretch of high interest rates has cooled the U.S. housing market, and just as cash-strapped homeowners were starting to see some relief, President Donald Trump's push to acquire Greenland helped push mortgage rates higher again. After falling to 3-year lows just days earlier, the average 30-year fixed rate climbed 14 basis points to 6.21%. And that 0.14% jump doesn't just look bad on a chart. Even a small move like this can mean thousands to tens of thousands of dollars over the life of a mortgage, depending on where you live. So how does a foreign policy fight end up inside of your mortgage payment? The president's claim that the U.S. must control Greenland for global security has triggered the deepest NATO rift in decades, possibly since the alliance's founding nearly 80 years ago. Following suggestions the U.S. might take the island by force if necessary, some European nations have dispatched small numbers of military personnel to the island. In response, President Trump said the countries had created an unacceptable level of risk. He said the U.S. would impose a 10% tariff on all goods they export to America starting February 1st. They would increase to 25% on June 1st and then be kept in place until a deal is reached for the U.S. to purchase Greenland. However, if the White House expected the move to shift European positions, it was mistaken. Instead, it appeared to harden their stance and deepen the dispute. Denmark's Defense Committee chair said Denmark and Greenland would not agree to any transfer of sovereignty. He added that pressure from Washington had only hardened their position. UK Prime Minister Sir Keir Starmer stated Greenland's future was a matter for Denmark and Greenland and criticized the use of tariffs between allies. The Swedish Prime Minister also rejected the approach, saying Sweden would not be pressured, and Norway's Prime Minister warned that threats had no place among allies. But the responses weren't just talk, the market started taking it personally. On a practical level, the EU announced it was discussing $108 billion in counter-tariffs and an anti-coercion instrument that could create $8 trillion in fallouts for U.S. assets. In other words, this wasn't just political noise, it was market-moving risk. And the markets didn't wait around. The moment investors saw tariffs and NATO tension moving together, they started dumping risk. There was a broad sell-off across stocks and bonds, giving Wall Street its worst session since October 2025. The Dow fell 1.8%, the S&P 500 dropped around 2%, and the Nasdaq slid over 2.4% as investors shifted away from risk. The losses wiped out year-to-date gains for both the Nasdaq and the S&P 500. The carnage spread to other assets as well. The dollar fell to a 2-week low as the Sell America trade resurfaced. Gold and silver rose to fresh record highs. Meanwhile, Nvidia and Broadcom led big tech lower as investors pulled back from riskier AI-linked stocks. But here is the part homeowners care about, the number that decides what you pay. The 10-year Treasury yield, a big driver of mortgage rates, rose by more than 4 basis points to 4.275%. Rising Treasury bond yields typically mean only one thing for homeowners: higher mortgage rates, with less money in your pocket as a result. The cost of owning a home depends on a lot of variables, including location, credit score, loan size, property taxes, and homeowners insurance. But for most buyers, the mortgage interest rate has the biggest impact on the monthly payment. As Jeannie Thomas, founder and president of Sarasota Mortgage Group LLC, told Yahoo Finance, mortgage interest rates are really important for homebuyers because they directly affect how much you pay each month. When rates are lower, your monthly payment is less, which makes buying a home more affordable for you. Lower rates bring payments down and expand affordability, while higher rates price more buyers out. And that is before factoring in property taxes, homeowners insurance, and other ownership costs. Fluctuations in mortgage rates aren't unusual. They're built into how the market works. Mortgage rates move constantly and they can change multiple times a day. Over longer periods, those shifts can be dramatic, significantly affecting how affordable it is to buy a home from one year to the next. In December 2018, for example, the 30-year mortgage rate stood at around 4.75%. By December 2020, thanks to the economic chaos caused by the COVID-19 pandemic, it had plummeted to 2.71%, a 57% drop. After COVID-19, inflation spiked as demand bounced back faster than the supply could keep up. The Federal Reserve responded by raising interest rates, which made borrowing more expensive across the economy. Mortgage rates more than doubled from their pandemic-era lows, rising above 7% before easing somewhat in the years that followed. The White House tried to push the rates down, and geopolitics pushed them back up. In early 2026, President Trump announced a new initiative aimed at pushing mortgage rates below 6% for the first time since 2022. In a post on Truth Social last week, he said he was directing his representatives, Fannie Mae and Freddie Mac, to buy $200 billion in mortgage bonds, arguing that it would bring mortgage rates and monthly payments back down. The two government-sponsored enterprises would expand their mortgage-backed security purchases to roughly 4 times the $50 billion they bought in 2024. And the tool they chose was basically flooding the market with demand. Mortgage-backed securities, or MBS, are investments built from bundles of home loans. Lenders sell mortgages to larger institutions which package them and sell investors the right to collect those payments. When demand for MBS goes up, their yields tend to fall, often pulling mortgage rates down with them. When demand drops, yields rise, and mortgage rates usually move higher. Buying mortgage-backed securities is a way to influence mortgage spreads, the gaps between the 10-year Treasury yield and the 30-year mortgage rates. Historically, mortgage rates tend to run about 1.8 percentage points above Treasury yields. In recent years, however, that gap has often been wider, helping keep mortgage rates elevated even when Treasury yields fall. When demand for mortgage-backed securities rises, spreads typically narrow, which can bring mortgage rates down. As a result, a major increase in MBS purchases can put downward pressure on mortgage rates, and rates fell to 3-year lows in the days following Trump's announcement. But even that isn't enough to fully control mortgage rates, because there are bigger forces moving them. According to Yahoo Finance, most experts agree that additional mortgage bond purchases could help lower mortgage rates, while only being a partial solution. That's because demand for mortgage-backed securities is only one of several factors that influence mortgage rates. And with the exception of very few individuals, such as the President, Federal Reserve Chair Jerome Powell, or Chinese President Xi Jinping, there's little you can do to influence most of them. The first is the strong link between mortgage rates and the federal funds rate, the rate banks charge each other for overnight loans. In essence, if the Fed cuts the federal funds rate, or even if investors expect the Fed to slash the rate soon, it's a safe bet mortgage rates will also fall. Inflation also plays a big role. When inflation is low, mortgage rates tend to stay lower too, but when prices rise quickly, lenders and investors usually want higher returns, which means higher mortgage rates. The state of the overall economy also influences demand for mortgages, and therefore the available borrowing rates. When people have jobs and they make more money, they feel better about buying a home. This in turn pushes up mortgage rates because more people want loans. But when the economy is weaker, fewer people are wanting mortgages, so the rates can fall. Government rules and programs also impact the overall economy in general, but specific mortgage-related rules and programs also play a major role in determining mortgage rates. Tax breaks, affordable housing loan programs, and the like can increase demand for mortgages, putting pressure on mortgage rates to rise. And as Greenland proves, mortgage rates don't just answer to U.S. policy. In periods of international stress, investors often move money into U.S. Treasuries for safety. That demand can push Treasury yields down, which can ease pressure on mortgage rates as well. The last and arguably most important factor affecting mortgages is the 10-year Treasury yield. Because the two are closely linked, mortgage rates often fall when the 10-year yield drops and rise when it climbs. As tensions over Greenland raise uncertainty across NATO and global markets, investors often reassess risk. That can push the U.S. 10-year Treasury yield higher, and when it rises, mortgage rates typically climb too, increasing borrowing costs for homeowners. Recent gains in housing market sentiment were quickly offset by renewed volatility, bringing mortgage rates back in line with levels seen through much of the fall of 2025. The effects could linger, especially if the Greenland dispute continues to affect markets. If the current rate trend holds, it could threaten the housing market's move toward a more stable footing. After 3 years of subdued home sales, many economists and market analysts had expected 2026 to mark the beginning of a gradual normalization, assuming mortgage rates trended lower and volatility eased. The longer the impasse drags on, the likelier we are to see elevated mortgage rates for longer, making homes less affordable or even completely unaffordable for millions of Americans. Whatever strategic, military, or financial benefits the administration sees in bringing Greenland under U.S. control, the resulting rise in borrowing costs could make homeownership harder to reach for many Americans. Of course, mortgage rates vary from lender to lender and from state to state, as do housing prices. As is often the case during periods of instability, Greenland-related market volatility is likely to hit lower-income homeowners harder than more affluent households. Mortgage rate differences between states are relatively small. In November, the gap between the highest and lowest average rates was only about 1/4 percentage point, ranging from roughly 6.57 to 6.60 at the highest end to 6.36 to 6.41% at the low end. However, the spread between average housing prices is usually a different story entirely. As of October last year, the average home in California would set you back around $833,000. On the other end of the spectrum, you could still pick up a new home for under $250,000 on average in places like Louisiana, Michigan, and West Virginia, with Iowa having the lowest average home price at $228,000. That 0.14% jump in the mortgage rate caused by the Greenland row hurts more than such a marginal increase would suggest. In California, a 0.14 percentage point jump in mortgage rates would raise the monthly payment by about $70, adding roughly $23,000 over the life of the loan. In Iowa, where the average home costs about 3.65 times less than California, the same rate increase would raise the monthly payment by about $35 a month. But relative to the home's price, that increase hits harder, adding roughly $12,700 over the full mortgage term. For lower-income households, even modest payment increases can be difficult to absorb. The longer higher rates persist, the more those pressures build. So, is this going to get worse, or is there a way out? Following the Greenland-related market turmoil and an appearance at the World Economic Forum in Davos in late January 2026, President Trump said he had reached a framework agreement with NATO on Greenland's future. He also withdrew his earlier threat of additional tariffs on European allies and said he would not use force to pursue U.S. ownership. While no further details have been made available yet, U.S. homeowners will be hoping the mortgage rate reacts just as sharply to this news as it did to the earlier Greenland developments, only in the opposite direction. If markets believe this dispute is cooling off, Treasury yields can fall and mortgage rates can drop with them. But if Greenland turns into a drawn-out standoff that keeps spooking investors, homebuyers could be stuck paying these higher rates for longer than anyone expected. Now go watch economists predict when the U.S. economy will crash. This is the date. Or click on this video instead.